Well, good afternoon and welcome to the Horowitz & Company 2022 March 8th update and outlook. I'm Andrew Horowitz. Thank you so much for joining me, everybody, today. We know we have a lot to talk about and get through because we know and I know and you know things are a little weird, to say the least. I mean, we have seen a tremendous amount of action in the markets. Some things are moving up very significantly and very quickly. Other things are getting absolutely pummeled. And we're going to go through some of the reasons, some of the outlook, some of the things that are going on. I'll ask you if you'd like, we will keep this to about an hour, and I'll try to wrap this up enough time for Q&A. If you have any questions, you can start loading them up right now in the Q&A panel that's on the Zoom platform there. So try not to put them in the chat because they become a little bit disorderly. So go over to the Q&A panel. Anything you have, any question you have at all, I'll make sure it's anonymous. And I'll answer the questions unless they're very basic. I can just answer directly. But the point is that this is your time to get some answers the best I can in the state of the current situation here, because obviously there's a lot of confusion that's going on. And there's a lot of questions that I still have because this is a rather unique situation. Not absolutely different than other things we've seen in the past, but it has its own differences that we really need to look at in a way that is not essentially a duplicate of something we've seen before. So with that, I just want to mention as we go, number one, this will be recorded and we will have this available for replay. So somebody that wants to listen to this again or would like to give this to somebody that is a client of ours, please keep it to just clients like your spouse that maybe didn't have the opportunity to see it. We'll send that out and give you that recording. I also want to mention a couple of disclosures. Of course, nothing that we talk about today is a recommendation to buy or sell any security. Nothing is designed to be tailored, individually directed advice, because obviously we're in a group situation here. So any questions you do have, please just ask them generally, or if we can't answer them, I will make sure to mention that as well. In addition to that, I want to mention that the discussions that we have today are for educational uses only, really, not to be implemented necessarily. We'll implement them on our side over here, obviously, and that's what we're doing. So, just keep that in mind. There are a variety of things that we really need to be talking about, and I think on top of everybody's mind right now, which is incredible change over the last few weeks, is this whole Russia-Ukraine crisis now being called Putin's war. But before we really get into all this outline, I want to take just a few minutes and talk about what is going on, because there's a lot to take in right now. And there's really no easy or quick answers that we could really just spray out there and put out that magic pixie dust and make everything just better, because there's so much going on. I'll ask you at this moment, and you may find this a little strange, let's just take a quick refreshing in and out breath, because a lot of this gets us tense. When we start talking about the things that we don't understand, I'm talking about all of us here, with what's going on politically and with the markets and what's happening with this new level of crazy that's happening, it gets us all a little, as my grandmother would say, famished, a little confused, a little upset, especially when it comes to our money. And I get it. And we have a lot that we've been looking at right now. There's a lot of things that we know. We understand about the economy. We understand about earnings. We understand about some of the companies' outlook that we've seen. And of course, things have changed. Just today, we saw McDonald's and Coca-Cola pull out of Russia, and other companies upon companies saying, you know what, we're not going to do business with you. And as an incredible example, McDonald's shut down 850 stores in McDonald's. That is going to be painful for their bottom line. Now, that may only represent a certain percent, but let's call it 5%, 4% for Coke. Pepsi has a little bit more exposure there. And then look at all the other countries that are involved in the region. Big problems. Some of the things that we really don't understand right now are things like, what is the outlook moving forward? And how much of what is going on is going to impact not only companies, but the economy, inflation, commodities, and what is the potential, which we've all been grasping at, looking for this answer. What is the possible resolution that is going to be out there when it comes to this whole Russia-Ukraine issue. I read a really great article today. There was 5 possible outcomes. And frankly, none of them were really good. There are some ideas out there that maybe what's going to happen, and we saw that move the markets dramatically today, where Ukraine would say, you know what, we are not interested, nor are we going to at all from this date forward pursue the membership in NATO. Well, that moved the markets probably 500 points on the Dow midday. And then, of course, Putin, there was some rumors floating around that he was going to close off Russia's exports entirely from top to bottom to certain countries. And those countries, of course, are the ones that are fighting him and NATO related. None of the ones that are helping him out, or at least not causing him problems. But we are clearly in unprecedented times right now, and that's what many are saying, and we have to question, are we? We're going to look at that today. If you notice, I'm going to back up a little bit. I put something on the first page here on the title cover. You see this? Right now, what we're looking at here? Right here. Many of you may have picked up on that. That's a black swan. That is a black swan. There's no question about it. The fact is that when I look at what's going on right now and the incredible change we've seen over the last 2 weeks or so, this is a classic black swan event that you get every decade or so. Pandemic, black swan event. You could have seen some of it coming because it came slowly, but still, did we know all of the impact of what we would see and the extent of it? 1987's market crash was a black swan event. The financial crisis was a black swan event. Some of these are predictable to an extent. A classic black swan event is an unpredictable event that is beyond what is normally expected of a situation in its entirety and has the potential to have severe consequences. Black swan events are characterized by their extreme rarity. They look at the severe impact differential of what we've seen in other kinds of events, and then widespread insistence that they were obvious in hindsight, right? We knew that we were going to see a crisis in 2008, sure. 2000, 2001 with the tech wreck, sure. All these things, we do look in the rearview mirror after some time and say, well, that was obvious. This situation, not so much. And I'll tell you why. What we have seen is an event that we all looked at very clearly. We knew for days in advance that Russia was probably going to attack and try to occupy and take over Ukraine. What we thought what was going to be was a significant amount of power, overwhelming power, that was utilized, and Ukraine would fall within days. But that didn't happen. That's still not the issue here. What the black swan event in this all has been is the response by the global system, the response by corporations and governments and people, the outrage of what is going on and cutting off and trying to absolutely decimate the financial system, suffocate Russia financially. That has knock-on effects that are incredible. We've seen commodity prices just get totally out of whack. Wheat is up 54% in 6 trading sessions. Oil rocketing higher, close to $130 per barrel today. We saw nickel, you know, the commodity, the metal that's utilized in things like batteries for EVs and other types of devices, industrial, is halted. And not only is it halted, they're not reopening it up till at least the 11th of March. It went up 250% in one day very quickly. It shot back down, but closed at over 100%. There looks to be about $2 to $3 billion in losses for those that hedged out in the wrong direction for nickel overnight. That happened last night. So we're going to talk a little bit about what's going on with the U.S. response to some of the things that are going on, the Federal Reserve, what they have to say, the supply chain inflation and commodities, of course, the volatility. Volatility is a big issue right now. We have the potential, and we do have, not even the potential, we do have, period, end of sentence, inflation, high inflation. There's a concern that we are going to enter into a time of stagflation, which is high inflation and high unemployment. We're nowhere near this yet. But even with low unemployment and lack of wage gain, these levels of inflation that we're seeing right now are very problematic. It's recession inflation is another name of what we may be seeing. And one more thing to consider, and I put this out there for you. I think it's really interesting to consider what we have seen over the past several decades and something that we've been looking at, and why, in fact, that our portfolios, our global allocations, and Vestology, our diversified portfolios. I'm not talking about our growth-oriented TDI managed growth strategy. That's a whole different animal. What I'm talking about is our bulk of what we have for our clients, which is a diversified portfolio structure that is domestic and international. It's bonds and equities. It's real estate. It's commodities like gold and silver. It is alternatives. It is a incredibly diverse way of investing to look at the opportunities that are out there, but also protect the downside. And that's what we're really looking to do in this kind of situation. When markets are just going up really nicely and we're capturing a good chunk of it, but not all of it, depending on where we are in the risk spectrum for any particular client, and if you're aggressive, if you're conservative, if you're moderate, on the downside is really where things are like, oh man, I'm glad I wasn't in those go-go names that are down 75% this year. But the consideration that we have to be looking at is the change of the dynamic of where we were over the last 2-3 decades, where we were going from a period of industrialization into the internet and technology phase that really revealed itself dramatically for the benefit of all of us in globalization, which was a deflationary type of situation, because the more technology we had, the more we could offshore, the more we had the opportunity to outsource to places that were a lot cheaper and had a lower cost of living overall, gave us the opportunity to keep prices down. And that was a deflationary or disinflationary environment, and that was really good for a lot of different reasons. We saw the yields on stock, on bonds, come down precipitously over the last 2 decades. That's all changing right now. The thing that I really want to focus on with you right now in this idea of what is changing so dramatically over the last couple of years is the movement from the area of globalization to nationalism to now what I'm starting to see and I'm calling selective isolationism, where countries and private companies are putting the screws to Russia and saying, you know what, we are going to isolate you from the rest of the world if you don't obey and fall in line with what we are thinking you should do. It's a new way to punish a bad actor. And it's, at the same time, we're saying, we also don't want to be reliant on China for this product, or we don't want to be reliant on Iran, Iraq, and Russia for our energy. We don't want to have a situation where we're going to be relying necessarily on a place south of the border, north of the border, east of our border, west of our border for our foodstuffs. And it's going to impact countries, and it's going to impact on how countries are going to interact with each other. Remember, again, we had all of this going on for years where the globalization was this exciting thing. And now here we're becoming either a self-imposed or an imposed security wall that is being put up around us, again, called selective isolationism. At least that's what I'm calling it, that I think is really interesting that's going on right now. So when we look at Russia and we look at Ukraine, I think we really need to focus in on historically, what did this look like? Did we have other things in our past that were at least similar that we could have an analogy or an analog to look at in the market, so we could understand a little bit better what all this means. Are there going to be peace talks? Are there not going to be peace talks? Is Russia going to go along and say, okay, we'll take this land just along this edge so we can get a little bit of access to the Black Sea, or we can have this edge over here because we can have access to the top end and we can waltz across, and we have who knows where it goes. Right now, it looks like we poked a bear. We put the bear in the corner. We've wounded him. Now we have a wounded bear in the corner. I don't think that's a good thing, because it's a big issue. When we see that Russia is doing sloppy work, like attacking the largest nuclear power plant, whether it was on purpose or by accident, whether it was because a Stinger missile went sideways or went the wrong way, or they didn't even know what that building was, because whatever the reason is, big problem. Well, the good news is currently there's no signs of elevated radiation. It was an area that was not necessarily holding any kind of reactor core materials. But, you start doing that and you start getting into the level of war crimes, and you're going to see NATO get involved here. When I say NATO, well, the U.S. I don't think it's going to come to that. I think that we're going to be on the outskirts of this whole thing, trying to push things through other countries and not get involved. We do not want to have a direct conflict, whether it's boots on the ground, planes in the air, ships. We don't want to see any of this with another nuclear superpower. Now, I will tell you, from all the work that I've been doing over the last couple of weeks, especially over the last week, I have listened to some fascinating and brilliant individuals that study Russian military, that look at Russian society, Russian politics. I've been listening to just an incredible range of people talking about what they think. And a lot of things that we are finding right now is Russia may not be as strong of a military, or better yet said, they may not be as organized as we thought they were. And you can see that because what is happening right now is, I would call, a failed attempt to take over Ukraine with what's going on. We've seen the globe, we've seen the world unify in all of this, presenting an incredible amount of pain on Russia, not only on Putin, but on the oligarchs, on the strong boys, and the asset forfeitures and seizures of yachts, restricting movements, talking about restricting certain airspace, cutting off cargo carriers, and people saying at the docks, I am not going to unload this cargo. It's from Russia. Send it back. So we have not only the governments and the companies, but the people that are under protest saying, this is just not right. I mean, for goodness sakes, we can't even get over a pandemic completely before we have to have a madman doing what they're doing now. And the question is the worst behind us yet? But I want to really focus back on this issue of major historical geopolitical shocks. What have we had? Because we forget. We forget. I remember because I remember when you call me, when he calls me, when she calls me, when they call me, and they say, what is going on? And I'm losing money and what's happening? And I try to put it back in perspective. Like, okay, I understand, but really in the big scheme of things, you can't make money all the time. In fact, a lot of times that we see these kind of situations, no matter how horrific it seems, it's some of the best times to put more money to work. Now, I'm not here just trying to press you to send in money, but I got to tell you, early in my career, I was taught something, and I thought it was really interesting. The lesson that I was taught was this. When things are really bad, and when you think, Mr. and Mrs. Client, that things are just, man, I'm losing money, and you get so frustrated that you just want to come to my office, and you want to throw a brick right through my building. When that time comes, exactly at that moment, I want you to take a pause just for a second. And I want you to take that brick in hand. With the other hand, I want you to take a bunch of money and wrap a rubber band around that brick, then throw it through my window. That's probably the best time it is to invest. And we've seen that time and time again. Now, I'm not advocating for buying the dip. I'm not advocating for, wow, this is going to be over quickly and this is going to be painless and we're not going to have any more problems from this. What I'm saying is, what are we doing? And that's the question I want to ask. What are we all about? Are we investing for today? No. Now, we may make moves here and there and adjust things, and we're doing a lot of things behind the scenes that may be seeming like, okay, well, we're not making any moves. Well, we did, in fact, a little secret. Come closer, come closer. We set portfolios up actually before the pandemic to have the diversification to ride out a variety of different circumstances. We made some adjustments throughout time and did some rebalancing but still to this day, if you really look at your portfolio and you count up where are the risk assets in the portfolio, really we're talking about in the moderate risk. And a lot of our clients are conservative to moderately conservative when we talk about our global allocations, Schwab portfolios, TD Ameritrade portfolios, and we're talking about 40 to 50% equity allocation. The remainder of the allocation would be in fixed income, short-term, short duration, so we don't get a lot of volatility. We have things that are inflation hedges in there that we've been looking to hold for a while that weren't working but are now working dramatically, like, for example, gold and silver. We have alternatives in the portfolio, like our alternative assets that are fund-to-fund, looking to be as uncorrelated as possible, or at least non-correlated as possible, to the rest of the market. Then we have things like real estate, and the list goes on in where the diversification comes in and how that plays out. And the reason for all of that is really because we want to make sure that we have a significant amount of opportunity, but yet at the same time, you know what? On the other hand, we're holding that umbrella. In case it really starts raining, we can pop it and it opens up, and ours is kind of automated. But again, major historical geopolitical shocks. I want to show you something. Check this out. Look at all these different events that have happened in the past. And I want you to look at some of the things that may seem like, wow, I remember that one. That was a big one. Back in 1940, we had the Germany invading France. And man, that was big. That started World War II, of course, or got into that point. And 1 week later, down 16%. 1 month later, after that date, and so on. But look at the rest of these. I think it's really interesting. We saw in 1973 the Nixon impeachment hearings, and that was a big issue. But in 73, we started to really get super inflation, and then Volcker came in, and a year later, well, that was further on a little bit. But point is, we started to see inflation start to pick up. But really, this was an unprecedented situation where we had the impeachment of our president, and a lot of things came into play. But, we look at other areas like the Beirut bombing. We thought that was going to be a big issue. Really wasn't. 1 week was a problem. A few months later was a problem, but it all played out and got green. But if you look at things like, the Iraqi war, where we started to see the Gulf War start back in 1990, it was pretty rough for about 2-3 months, is where we are right now in the situation. But 1 year later, that all resolved out pretty nicely. World Trade Center, remember that? Oh, that was bad. World Trade Center bombing, 1990, it was 93, I thought it was 92. Maybe it was 1993. But we saw that was pretty much a smooth sailing right there all the way through. Oklahoma City, same thing, and all this. Now, that was the original World Trade Center bombing. Then, there we go. Then we saw 9/11, but I still thought it was 92. But anyway, 9/11 happened, and what did we see? Well, the markets were down 5.5%, but 1 year later, we started to get into the situation that was a little bit different. It really wasn't 9/11. It was really the technology plunge that went on back then. Iraqi war. Anyway, my point, if you really look at this, Russia invades Ukraine. Well, this was as of 3/4. This is a few days ago, but still, 1 week later, we were up 3.27%. It's this maybe, sell the rumor, buy the news kind of concept. And 1 month to date, when we saw that was only a few days later, 1.7%. Where are we right now? Probably flat to down ever so slightly, but it's not as bad. Even though we're seeing this crazy amount of volatility in the markets today, 600-point swing. The other day, 6. It's like a magical number, 600-point swing. All right, moving along here. In the State of the Union, we got a couple of highlights, things I want to touch on. COVID, well, no longer controlling our lives. In fact, it's pretty interesting. We leave off COVID, we now have something else to worry about. Businesses are open, schools are open. Inflation. Some really weird concepts talked about when it comes to inflation. We're going to try to reduce the cost of childcare and healthcare and prescription drugs. That's not our problem. I mean, it's a problem. It's definitely a problem. Right now, the problem's food, energy. That's a big issue. The input costs into plastics. We're looking at additives. We're looking at chemicals. Those are the things that are really going to drive up prices. These other things, it's important. I get it. But these are not the hyperinflation items that we have really in front of us right now. And I think the Biden administration is a little bit out of touch with some of the things they're talking about. They're blaming the oil companies on the inflation, which is really not the fact of oil prices. Some of it was the case, but really right now there's a bigger issue. Climate change, important, no question about it. But we really need to have the ability to run our lives before we could really change what's happening with the climate right now. We could try to do it all together and all at the same time, but it has to be done in a way that at the same time it's not, well, I don't want to say disruptive because I'm not trying to minimize climate change. It's a very important issue. But the fact of the matter is we need to not do things that would cause us to go into a financial ruin and not allow us then to address the climate change issue, if that makes any more sense. Big issues right now, again, are increasing competition. That's the things they're talking about. But really what needs to be done is a different landscape for what's going on right now. We have a meeting coming up on on March 16th of the Federal Reserve. And we had the expectation, which I never really believed, that we would see a 50 basis points or 0.5% hike that was going to come during this because we saw the inflation numbers go and move, and we were seeing negative real rates of returns, and that was still being very loose on the economy. We saw that while they were winding down their quantitative easing program, there was a significant amount of inflation still happening here. And then we saw this happen, and the Fed needs to keep liquidity in the markets. They need to make sure that they don't do anything to create more of a shock because already financial conditions have constrained and condensed in a way that has been very significant, and that came from simply the Fed talking. It came from the Fed simply talking up their story about how they were going to raise rates, and then markets adjusted. And what we saw in the last several weeks was a much more dovish tone, and it has to be. When we saw what happened through when Russia decided to invade Ukraine, and we saw what happened with gas prices, wheat prices, and corn prices, and nickel prices, and name all your commodities out there, there's a reason and a good case for a pause of the rhetoric. While they need to do something, because right now, if all things being equal, if we were in a normalized situation, I would say, the Fed shouldn't be doing anything. If anything, they need to actually start liquefying. And they're doing that in the background to make sure the banks stay in good shape because of all things that are going on, of course. But they need to make sure that we're not going to rush into a recession because with an extremely high level of oil price increasing 100% over the last year, there's a high likelihood that if nothing else, we're going to go into a technical recession. The price of the pump, I looked out my window today, $4.50. It was $3.50 just a couple of days ago. That's a big move. Around the country, we're seeing $6 and $7. In California, of course, with all the excess taxes they have going on over there, and at the wrong time of the year, by the way, for this to be happening, you got to admit that if Putin was trying to disrupt things, he did a pretty good job. But at the same time, while the Fed needs to act, increasing by 25 basis points, increasing by 2%, 4% is not going to change the fact there is a supply-demand imbalance when it comes to a lot of things right now due to the fact that one of the largest outputters of wheat is now immersed in a war, where 10% of some of the world's oil comes from is being shut down. So big problem right now, and whereas OPEC is saying, I don't think we're going to pump much more. And in the country here, we did a terrible job of shutting down things because we were pissed off about all the pollution, and right now we're paying the price for it. That's what's happening right now. So the tone of the Fed is definitely more, I would say, conservative right now, but at the same time, they are open to being more aggressive should inflation quicken, which I don't know. It seems like illogical to me. It is quickening. So from the congressional testimony that we saw recently, we're going to avoid adding uncertainty to what is already an extraordinarily challenging and uncertain moment. Okay. Inflation we know is well above the 2% thing. So the labor market being extremely tight, strong wage growth. Last week's number we saw on Friday, 3.8% print on the unemployment rate. Everything is doing well in the economy as a backdrop. That's probably changing very quickly with the pricing issue. Here's just a quick chart, shows us the probabilities, and really what we want to focus in on is the meeting date right there. Again, March 16th, 92 plus 8, 100% chance of a rate increase. 8% they're not doing anything, 92% chance they're moving up, but basically they're pretty much 100%. Moving into our May meeting, we're looking at then a 6.8% chance of doing nothing from this meeting and an 80% chance of moving up even more. And you can see the range as we go right up until, I would say, the July meeting. Pretty much 50-50 or better shot of a 25 basis here, 25 basis May, 25 basis June, you read across, and then in July. U.S. inflation trends. Well, we know that this has been pretty spectacular. We know that we saw a deflationary environment that really kicked in very strongly, right? This is right here. We know that March 2020, what do we have there? Well, we had the shutdowns and the economy was shut down. And this move was very severe at the time, negative 2%. And then we were able to get it up to 2% pretty much in March of 2021. And then things went haywire, just haywire. We looked at the year over year for PPI and X foods, but also the CPI. So CPI being what you and I pay for things, and PPI being the other areas like what goes into the manufacturing process. Global inflation trends, yeah, we're pretty hot right now. This is us right here. But also Japan, hot, hot, hot. Not so much down here. Japan's at 1.5, but they were negative 1.5 here, and then really slowly moved up. China CPI at 0.5, but the rest of the European markets and the UK and the Eurozone are really approaching that whole 5% range right over here. So that's a big issue that's going on. And that's what the Fed is really trying to combat right now. The other thing that we look at, of course, is the gasoline versus crude oil pricing. We can see what's happening over the last few weeks. This is not anything that is, I think, escaping you at all as you're looking at this. Like, well, I know that. But this is pretty high. And going back to 2017. I mean, we saw a big dip right here, right? $1.75 at the pump back in March or April of 2020 when we saw that shutdown happen. We see crude oil just rebound, wow, from negative $40 a barrel. Gasoline prices, dramatic. And that's a big problem. They will follow those, across. And commodity trends, we see things like gold and silver. I mean, gold is moving along, okay. But again, aluminum, corn, wheat, look at these parabolic moves right here. We're looking at silver coming off the bottom, up 20% over the last year. Gold up about 12% over the last year. Pretty astounding moves overall. Volatility index, one of the things that really you have to look at is where we are, because when you see a volatility index here, which is over and above what you've seen really for a long period of time, the worst was February of 2021, we seem to have these bouts with volatility right in the beginning of the year usually. Look at we saw in January, February, March 2021, a year ago, this bout, then it started moving back down again to the 15 range. Popped in the end of the year a little bit, then came back down a bit, and then is moving progressively, if you can look at this higher on this bar. What's interesting and why you want to have why do we have the diversification we have is because of this right here in front of you. And we go back in time, we have this going back 20 years, and we look at this regularly to see where we are at any given point of time in terms of what sectors are performing and outperforming. And what you'll notice here is back in 2017 and 2019, and when you look at where we are over this period, where you see it like, back commodities really right here, we're down 4%, down 8%. They were up 10% in 2019, then they started moving up and up and up. That's your oil, that's your basket of goods, if you will. REITs last year were our number one performer in our portfolios, up 38%. You thought that large cap stocks were doing pretty good last year, right? Foreign even had a decent year. But U.S. REITs, we had a smashing year last year with that. That really helped portfolios. Point, though, is if you look on this chart and just try to pick out a color, oftentimes you'll see large cap do well throughout the last number of years. This year, down 8% through the 4th of March. But everything is down significantly. REITs this year taking back some of the gains they gave last year. Large caps down 8.6. Now, we have a slant and a tilt in our portfolio that bends towards the value side, the energy, the financials, the staples, the utilities. We are bent in every one of our portfolios in the global allocations and Investology because the TDI Managed Growth Strategy, if anybody's there, we talk about this a lot. This is really, we're focusing this discussion today more on our diversified portfolios because we talk through our daily updates with the TDI Managed Growth Strategy. You know what's going on there, and that's something we do communicate a lot on. But this discussion today is really about where are we and where's our tilt and why this year, people are really worried. I got an email from somebody. today that says, do me a favor. If I see, if my portfolio goes down 10% in a day, could you please cash me out? And I wrote back, I said, 10% a day? 10% a day? Hold on a second. The fact of the matter is that when we have a situation that you would be down 10% a day with his particular portfolio, which is one of these global allocation portfolio strategies, that means markets would have to be down like 20%, I'll call it 20% in one day. Equity markets, and we'd have to see a blow up in bonds a bit to a degree, not really moving higher for a safety trade. When has that happened? The last time I recognize that happened was like the flash crash in 1987. And that was a quick, very scary situation. Resolved very quickly, though. My point, though, is that we see this large cap, that's the totality of large caps down 8.6% for the year. Now probably down 11% a few days later. But, that's split in growth and value. Now, if we were to give our level, and I'm just going to use the same date, 3-4 here, because I want to keep it apples to apples. If the large caps were down 8.6%, and we have a slant towards large cap value, which is only down about 3%, where the large caps were down about in totality about 12% at that point, we would say our large caps were down 5% at that point. So there is, give or take, 5.5%. Now that is pretty significant. And when you calculate where our equity allocation is, you think about where it is, that's why our portfolios are holding up pretty well on a relative basis. Is there a positive print in our portfolios right now? No. But again, we can't expect to have a positive print every single year. But I don't think that right now is a time to panic because of the way that our portfolios are structured. That does not mean there's going to be no more pain. That does not mean that we're not going to see something crazy happen in the world. But the fact of the matter is, again, what are we investing for? Today, tomorrow, or 5 or 10 years from now? Are we looking for, yes, some income now? Of course. But when we look at this and we go backwards and we look at this and recognize that over time, things usually do come out the other end pretty good. What we want to do is start thinking about putting money to work and more money to work. And possibly when we see these things, there are those times that we will move around our portfolio and blend out some of the bond exposure, possibly to equities. Not yet. We're not there yet. I'm pretty happy with how the portfolios are reacting right now. I'm not thrilled. I don't like to lose money, just like you don't like to lose money. But, we all are doing this for the same reason. We didn't think that there was no risk going into any of this, did we? Or did we? No, there's risk. We know. Let's look at here. Okay. The other one is, this is what I want to show you, the domestic style rotation here as well. What we have here is, when we look to the right side of what we're looking at here, the U.S. large cap value down 3%. Contrast that with the U.S. large growth, right? It's the same dates. That's what I was telling you before. We have the 70+% of our equity allocation on the large cap, 65 to 70, in the large value versus the large growth. You see that difference. Now, last year, that didn't help us as much. It was a blending out here. The year before didn't help us as much. But you'll notice the past few years, it's been all over the place. But here's where the rubber meets the road, where things are starting to hurt. And it is causing us to actually have a much better outlook for our portfolios right now. And like I said, you have to put in perspective. I talked about this on the Disciplined Investor podcast this week. The idea of time frame, time horizon. What's your time horizon? If you're going to panic about what's happening today, tomorrow, this week, this month, I have no problem with that. I get upset too. Listen, when I can tell you right now, last week on Thursday, I know exactly where I was. In the evening, when a news flash came across my phone and said that Russia had attacked a Ukrainian nuclear power plant and there was potentially traces of radiation being detected, I freaked out. I totally freaked out. I said, what is going on here? And I looked at what was happening with markets at that point. It was very ugly. They did repair themselves by the end of the day because they realized that that wasn't a big deal, and it was an inactive area that was targeted. Not a good situation at all, by the way, but it's what happened, right? So when we look at the time frame, I said to myself, well, what's my time frame here? Am I investing for tonight? Well, maybe if you're a trader, that's okay. Nothing wrong with that. Am I investing for next year? If I'm investing only for next year, I probably don't want to be invested because we don't know what's going to happen in any 3 month, 6 month period. But when we look from a historical perspective and we start to really focus in on what it is that we are doing here, all of us, and why we are investing and what the last 10, 5, 20, 30, 50 years is all about. And while we may not be happy right now and it's very uncomfortable what's happening because there's a lot of unknowns, you know what? What are the alternatives? Go to cash and then what? No yield on that. You'll never get back in. Be 1 foot in, 1 foot out like we are now with your portfolios where we have some cash, we have alternatives, we have commodities, we have some real estate, we have international domestic, we have small positioning in these areas to make sure to our best ability that we have what I would call an all-weather portfolio. Wherever I've said, and you've heard me say this, our flower garden thesis, right? Where basically if you have a flower garden that is filled up with impatiens that look beautiful during the summer or the winter months, depending on where you live, and they look beautiful, but 3 months later, they die and they're just stems and dirt. That's not a good kind of portfolio to have because it'll look great for a while, then nothing. What we want to have is roses and heliconia and the impatiens and evergreens. We want to have annuals and perennials, something in bloom at any given time. Whereas there may be a cold season where, in fact, there's a lot of death and destruction inside of that flower garden, but there are things that will withstand that storm no matter what happens. So consider the flower garden as we think about our portfolio diversification. Now, I'll mention we'll open this up to questions that you may have. A lot of things we've answered, of course. If any questions have come in by emails, I will ask you and encourage you to ask any questions you want. And I will answer them. And if you want, I'll leave them anonymous. This way you can feel that you could ask anything at all about any of the topics we talked about or something else that may be on your mind about what's going on right now or where our heads are at with your portfolio. But I do think if you think about the flower garden, you think about take away the flower garden, take away the idea of diversification, think about really where your portfolio is exposed and how we have you structured. Look at the idea of what I talked to you about, the brick through the window, and consider the chart and table that I presented you with, things really look bad now, but what is my time horizon? What am I looking at? Those are things I really want you to take away from this discussion today. Yes, things are really bad. I'm upset. The idea that we have to even deal with this crap is overwhelming. But these are the things that we have to deal with. Yes, he's a madman. He's crazy. With all this other stuff you want to talk about, this shouldn't be happening. I'm with you on all of that. So consider all that's happening right there. Okay, first question coming in, and I will put this in the chat first. Please ask your questions in the Q&A panel. Do you see the Q&A panel? There should be something in your Zoom meetings area that says Q&A. You can pop a question in there. We only have one question, actually. I think I had a couple that came in by email. I don't know if I grabbed those. There may be some that people asked in advance. Let's see if I have any here. Okay. First question I have here, or the only question I have really on the chat, which is interesting because there's so many people here. So either I put everybody to sleep, which is possible. I've been known to do that. I answered all your questions. Very improbable. Okay, probably not the case. Or, really, there's nothing much to talk about, and we understand. And that maybe that's good because we've talked about this kind of thing for years. And many of my clients and many of you have been here for years and decades. We've been together. So, first question: due to increasing gas pricing, do I think that we will ration gas as we did in the 70s? Now, as I answer that question, can I please tell you a funny story? This is embarrassing, but it's funny. Back in the 70s, I lived in New York, and I remember very distinctly that we had this odd and even license plate thing going on where certain days, if you were odd license plate, you could fill up, and other days it was even, you could fill up, and there was long lines, and everybody seemed to feel they needed to go to the gas station even if they were full and wait on a 2-hour line to get 3 gallons, and it was a weird time. I think a lot of us remember that. It was an awful time. Well, a couple things my dad did. He would switch the license plates on the cars. We had 2 cars, and he would go fill up. But besides that, he decided that wasn't a good thing to do. You know what? One of the cars that he had a lot of gas. The other car didn't have a lot of gas, and he didn't want to switch the plates, so he thought he would siphon the gas from one of the cars, put it in a bucket, and put the gas in the other car, and then take this car and go get gas. Well, he tried to do it. It was kind of weird. He sucked on the tube, and the I was young, by the way, and gas got in his mouth. It was bad. He decided he's going to do a much more effective way of siphoning the gas. So what my dad did was he came up with a great idea. He went in the garage and came out with the shop vac. And what do you think he did? Well, he put the shop vac tube down inside of the gas tank, turned the shop vac on, and what had happened? Sure enough, sucked out a ton of gas out of the car. Well, what happened next? Well, what happened is he wanted to look and see how much gas he got inside of the shop vac. So he opened up the shop vac. Hey, pretty good. Look at that. Okay, good. Closed it back up and then turned it on. Well, mind you, there was a spark that was emitted through a combustible tank. Thing blew up through me like 10 feet, and pretty crazy. And I think that was that was kind of the crazy point of that, and how things got. Answer your question. I don't think we're going to go to gas rationing. I just can't imagine it. First of all, there's too many opportunities. Cars are much more efficient. There is a lot of EVs out there as well, which is really interesting that we're still seeing some gas and production problems in the oil and supply-demand curve on that. But, I think that this is going to be a big push, and why we're seeing some of the EV stocks kind of hold up pretty well right now, which is really interesting. So I don't see it at this point, and especially with the fact that Russia's not a really big problem. Now, they may see it in Europe. They are highly dependent on Russian fuel in Europe. That's a problem. That's a big problem. And Europe is something that we are really looking at very closely right now. I'll tell you, at the beginning of the year, when I looked at valuation comparisons from the U.S. and Europe, and I looked at all the numbers, and I said, you know what? We're going to continue to hold our European exposure. We're going to increase our EM, or hold our EM and keep on pushing into that over time. That's emerging markets, by the way. Now I'm starting to think that maybe we're going to have a second thought on that. Next question comes in: is becoming energy independent, or at least substantially independent, a myth? I thought we were. I don't. What happened? I thought we were totally energy independent like 2 years ago. What the hell happened? Now we got a situation where, again, for the goodness of the planet, we had to change up and do all this EV stuff, not thinking that, man, we got to create electricity. That's coal and that's dirty, but okay. And that we may have a situation with some of the materials that go into the batteries, but we may run out or raise prices, but okay. This energy independent thing, I don't understand. We had so much going on in the area of drilling. We shut it down. We closed the pipeline. It's mind-boggling to me, and I just don't understand. It is a big lesson to those out there. And if the one thing that can cure higher prices, by the way, is higher prices, the one thing that will create a change is going to be the prices, I think, and force companies and the government to reopen that. That's a good question. The question comes in: Are we in a commodity super cycle? How further would it go? I mean, is a super cycle? It's like a 2-week super cycle. I mean, they've been moving up. Don't get me wrong, but this has gotten out of hand in the last few weeks. So we were in a commodity inflation move that has become a ridiculous hyper commodity super duper. Let's call it a super duper cycle in the last few weeks. How much further going to go? Listen, if they shut down this or shut down that, the problem is that we're going to have food issues. That I have a problem with. Food prices and wheat prices, corn prices. That's an issue I really am I object to greatly. One thing I could do is drive a little bit less. I mean, most people don't want to eat less, right? Or at least, you talk about gas lines. I could deal with that, but food lines? I can't deal with that. And most people can't. I don't think we're going to get to that. I really don't. I mean, we have enough growth and goods here. But at the same time, we have a situation where there is an artificial pressure that has been building. And it really has been screw you, get back at, payback is a bitch kind of thing that's gone on recently with the price of commodities, crude, natural gas, etc. Again, thank goodness you're not in Europe because things there are really crazy in terms of prices. The other thing is the world going towards deglobalization. I call it selective isolationism. And is it better to invest in more local equities? It is in a way. That's what I was talking about. Generally speaking, I think that the opportunity in local, and again, when you say local, U.S. based is coming back, even though I thought the opportunities and the valuations in some of the international. Now, again, separate that from our global allocations to our TDI managed growth. TDI managed growth is a lot. As a matter of fact, we put this up in the room. What I found in the blog post in our daily update, what I thought fascinating, the last turn, which was last week, of our equity exposure, we have a ton of energy in there, which has been very good in a really crappy market condition. But our energy exposure just expanded dramatically. And I thought that was pretty fascinating. Okay. Next question. Thanks, Andrew. You're welcome. Are you making any current trades or repositioning, or is it stay the course with the diversified portfolios until there is an opportunity to move to more equities or other rebounds later? Yeah, that's a good question. What I'm saying is we have a really. So I like to look outward a period of time. I'll call it 6 months to a year, and try to make the appropriate portfolio calculations based on a outward look of time in the future. Now, this situation has put a little crimp in that whole idea, right? It's very difficult to look out 6 months to a year because it's a very untenable and a very uncertain environment that we're in right now. However, I will share with you that the portfolios that we have created over time and tweaked a little bit here and there have been very appropriate for where we are right now. I've been a little bit more doomsday-ish since before COVID. Didn't hop aboard the gravy train as much as we should have, but did to a degree on the equity side, but still very concerned about valuations for some time, and decided, you know what, we're not making that much of a dramatic move. There is a slight equity increase that we just calculated in, that when we rebalance, that will happen, and that will naturally be part of the process when we do the rebalance. Do I want to just go, oh, this is the bottom, hey, put some more in? No. We've been so careful to build portfolios for steadiness and for opportunity at the same time, for a balance, that I don't want to just trade in and out so quickly with these portfolios. What I ask people to do, though, and we've had some people do this, if you feel that you would like to increase your risk, we'll change your portfolio profile. The risk factor in your portfolio, that we can do. But if we are in a certain profile of risk and time horizon, those are going to be rotated in over time and rebalanced. I just don't think it's the time right now to do it. And if I'm wrong, it's okay. We'll miss a little bit. I'm not that concerned. you know what? I'd rather be safe than sorry right now with all the things we have in front of us. Another question, what is the impact of market cap weighted index such as the S&P 500, SPY, and QQQ on large cap growth weighted tech names? Compare and contrast market cap weightings to small number of large cap growth companies. So what the question here is, the indices that we have right now that we look at all the time, not the Dow, the S&P 500, the small caps, the NASDAQ are all market cap weighted, meaning the larger companies have hold a much larger position in the overall index. Therefore, the sway of the index is greatly moved by the performance of those larger stocks to a big way. Some very substantially, like in the QQQ, less to a degree in the S&P 500, and the Dow is what's called a price-weighted portfolio. The higher the price of the stock, the more weight it has in the Dow. I think there is a big issue right there that has been something where we've seen over the last couple of 3 years that market cap weighting, index investing, passive investing in that style has done a very good job for those, because those have been the ones that have been outperforming. Now they are not necessarily underperforming, but they're not performing, and therefore things are coming down, and that's what's happening right now. The market peak at 2000, I don't know if the same situation is really growing, because these companies like the Apple, the Netflix, the Microsoft, the Googles, think of the names that are out there that are the big market cap leaders. I don't necessarily think that those are as vulnerable right now because they've already come down substantially, 20% already, many of these names. So there's a lot to that question. If you want to ask me offline, we can get into that a little bit deeper. Next question. What do you think in the upward cap? What do you think is the upward cap on gas prices? I recall from 2008, many people seemed to cut back on driving when gas price reached $4.50 to $5 a gallon. What do you think the new cap is? Again, I think you're spot on. The best way to combat high prices is higher prices. The more prices go up, people will say, hey, you know what? I'm going to find other modes of transportation or do something different. Now, you could tell this because have you ever driven down the road lately and seen all the pickup trucks and the SUVs and the inefficient gas-guzzling cars that are out there? Why is that? Because gas was cheap. You knew there was a problem when Ford and GM shut down all their sedan manufacturing facilities and turned them in for the F-150s or the Rams, right? You're like, oh, how is that going to end? That's going to be a problem. So here we are in a situation where EVs are a big issue. People are going to be looking for EVs. Why not? Looking for better efficiency on fuel and not want to deal with this again, especially people that are older and had to deal with this more than one time. I do think there is a cap. I'm starting to see 450 already around here, and that's pretty crazy in Florida. Our last question here is, what do you think is... Oh, no, that's the same thing we saw that. That's the same question. That's the same question. I don't know how I got in two places. Here's the last question. Do you see the... I found it now. Do you see the yield curve inverting this year? Should we expect some sort of recession following that? What kind of hedges should we use to tackle yield curve inversion? Oh, that's a good question. So, one of the things that we've done is, again, we're really focusing on our global allocation portfolios today. A much different discussion in our opportunistic managed growth strategy. But let me just focus on the global allocations and investology for 1 second here, because I think it's really important. I think the idea of where our fixed income portfolio is positioned, primarily in the U.S., is short duration. If you think about a seesaw or a teeter-totter, people may call it, and you think about when one side goes up, the other side goes down. When yields go up, prices go down. Or when prices go down, yields go up. It depends on how you want to look at it, and vice versa with that exact equation. The fact of the matter is, the longer you are out on the teeter-totter, the more you go up and down. If you are centrally located towards the center, there's not a lot of movement. If you're at that fulcrum point right in the middle of the teeter-totter, you're not going to see a lot of movement back and forth. Again, as you go out, you will. Therefore, why are our portfolios structured in a way that we have short duration, short maturities, or at least not long? We have some midterm in there, okay, in some of the positions, but again, not a big position. We do have some areas, again, in the international and the emerging market that I was a big fan of until 2 weeks ago. And now we're starting to think, where is that going? What are we going to do about it? EM could be good in certain respects because gas prices are good, commodity prices are good. Therefore, those economies could do well. You look at things like Australia, potentially, which is having some problems, but yet Canada, with a lot of energy, uranium, gold, silver, various other materials. You look at some areas in Central America. These are areas that could be very much benefited from an economic standpoint, and their bonds could do well. So you can't just say, well, EM is going to be maybe, China that could be slowing down or something. You have to look at the whole totality of where that is. So something to think about. It is 6 o'clock. We are going to cut this off. I want to thank everybody for joining me. Big group today. A lot of really good questions, a lot of concerns out there, and I get it. You have any questions? You have my email. You want to talk? Let's set a time to talk. Throw that brick in my window soon, okay? I think that's really a smart thing to take away from this. Thank you so much for joining me. Thank you for being there. I am here for you. We are working this out. We will figure this out. We will do what we can to help you and make sure that you are set for your financial security. That is the number one name of the game right now on where we are. Again, thanks for joining me so much. I'll see you soon. Listen to the podcast. And if you need me, I am just a call or an email away. Thanks so much. Bye-bye.